Hi everyone, it's Andy here from Money Release. Today I've got a really cool video for you. It was actually came about from one of our morning Zoom meetings. I was having a chat with some of the other staff, and Carol actually mentioned to me that she's been speaking with a few people recently that have kind of asked for the sort of fundamentals of equity release. So the first question that was asked is kind of just a generic, what is equity release? So I was trying to think about the best way of explaining this to someone that's sort of new, completely new to the industry, doesn't know anything about equity release, because that's one of the big things is you don't really get taught what equity release is in school or anything. It's not desperately something you'd even see in the general market. You know, as you're growing up, you know, maybe you buy a property and maybe, you know, you need a mortgage for it. And that sort of becomes the way that you learn about how those sorts of things work. But with equity release, because you kind of don't get it until you're at least 55, it's something that, you know, can be not very well understood. A lot of the information that's out there can be quite dated. And that's one of the things that comes up all the time. Lots of, you know, my mate told me that, down the pub I heard that, and lots of those things just aren't really true anymore. So the first thing we're going to talk about is what is equity release. It's a sort of a blanket term that we use to describe financial products that you can use to help release some of the capital that's built up in your property. The most common is a lifetime mortgage, and that makes up at least 99%, way more probably, of the equity release plans that I recommend. Lifetime mortgages have been around for countless years. I mean, we're talking like, you know, equity release market being around for 30 plus years. But lifetime mortgages have become much more tightly regulated, and the features that are available are so much better now than they were even, you know, 5 years ago. So if you even if you think you know what equity release, it's still worth kind of going through these fundamentals. So with lifetime mortgages, it's like a normal residential mortgage. So it's secured on your property as a charge. It gets registered with land registry. But the biggest difference is that you don't have to make payments on it if you don't want to. Instead, the interest that accrues on the mortgage just rolls up in the background, and then when you either pass away or move into a care home, that's the sort of natural term end where the lender would be expected to be repaid. If you're borrowing with someone else, like if there's a joint application, maybe a husband and wife, then it's not just a case of the first one that dies, lender's knocking on the door trying to kick you out. It would be the death of the last policyholder, or when that last person moves into a care home. So you've got a lot of protections in there now that you didn't used to have in the past. You know, and it is actually physically written in. They cannot evict you from your property if you stick to the terms and conditions of the mortgage. The lender can't just go, oh, you know, oh, house prices have fallen a bit, or actually I could do that money back now. I'll just call it in early. That just doesn't exist. And one of the big things that has happened is the introduction of the Equity Release Council. Now they have been around for some time, and they've incorporated the old SHIP standards for products. But it's really important that whenever you look at equity release, you only consider ones that are Equity Release Council approved. They afford you lots of extra protections, things like you have the permanent right to reside in your home until you either pass away or move into long-term care. Also for lifetime mortgages, they said that interest must be fixed, and not just like fixed for, you know, 2 years or 5 years, fixed indefinitely. So, you know, just think about that. If you're, you know, in your 50s, your 60s, 70s, you might have 20, 30, 40 odd years ahead of you, and you can fix interest now forever. I mean, it blows my mind. I just don't think there's any other sort of financial product that you can do that. So interest rates, you might find they're slightly higher than you might be used to with like residential mortgages. I know that there's you know, sub 2% mortgages in the industry. But when we're looking at lifetime mortgages, because we've got that fixed nature where it's indefinite, and the lenders are having to think, well, what happens in the future? If interest rates do go up, how do we protect ourselves? So the way that they do it is they just basically price it slightly above that. So interest rates probably start in the mid 2s, and they go up to about 7%. At sort of the top end. And in terms of the interest rate that you can achieve, it really depends on the loan amount much more than anything else. So if you are, you know, wanting to borrow, you know, a reasonable sum of money, the minimum amount is £10,000, then you can be looking at maybe the bottom end of the scale. But as you get older, you can release larger percentages of your property. I've actually got a note of it here. So at 55, which is when the plan starts, the maximum that you can release is 27% of your property value. And then that increases roughly about 1% a year up until you're in your sort of mid-80s, by which point it's about 58%. And then it sort of stays capped at that, regardless of how old you are. And don't worry, it doesn't matter if you're older than that, you can still get equity release. I mean, the client, there is no cap as such. You could be in your hundreds and still be able to get equity release. The sort of biggest break point though is probably around age 60. So 55, 1% a year, you get to age 60 and it's sort of about a 3% jump at that point. So sort of bear that in mind as to sort of how much you can get. I've actually got a calculator on our website that you can use, which will give you instant results, so you can see exactly what the maximum amount that you can release is. The video may very well be hosted on the website. You may have even come to the video from the website, but it's moneyrelease.co.uk, and you can find our calculator, which will give you an idea of the maximum that you can release. So in terms of the actual sort of loan amounts themselves, I know one of the things that people ask is like, well, what can I use it on and how does that actually sort of work? So there aren't any implications as to what you can use it on. As long as it's legal, you can basically use the money as you wish. And really importantly as well is because it's a loan, there's no tax to pay. It's not like income that you have to declare for anything. It can be a great way of taking cash out of your property that is, as I say, completely tax-free. You can use it as you wish. Obviously the money, because it is a loan, does have to be repaid back at the end, and that's obviously the point where the interest that's accrued on the plan would get paid back as well. A really important thing though, just to mention, is that if you have a mortgage, it does need clearing. If you're looking at the equity release and you can say, oh great, I can release 30% of my property value, that's very true, but you also need to clear any outstanding mortgages. It's not normally a problem because you can use the equity release funds to do so, but there might be occasions where there's a bit of a shortfall, especially if you're like a younger borrower, or you've got like a big interest only mortgage. They're generally the sorts of times that people would struggle with things. Don't worry initially though, there are sort of other options that we can consider. So if you've potentially got any medical enhancements or ailments, there are plans that are medically underwritten, and what the lenders do there is they basically treat you as if you're a bit older, because they say, well, if you're a smoker or you're diabetic or you're obese or you've got heart problems and things or cancers and stuff, that could give you access to further funds, or it could give you a lower interest rate. So that's a really important thing to mention is, whilst we've got the sort of calculator gives you a bit of an idea as to what's available, it is kind of dependent on your specific situation. Plus there are also other plans that if you make payments towards them, then you can actually borrow more money. So there are considerations there if you do find yourself a bit short. The next thing that I wanted to talk about is how equity release gets paid back. Now, what I probably haven't mentioned at the moment is there are actually two types of equity release. The first being the lifetime mortgages, which we've been discussing so far, and they make up like nearly all of the products that that we recommend, just because they're far superior. You own your home, you remain the homeowner, you can move it to a new property, you can take it with you, import it, you can repay it if you want to, you make benefit if your property prices increase. You've just got a loan, the interest rate, how the loan amount accrues, so you can really plan ahead for that, and it seems like a much more fairer way of doing it. And also with the equity release council protections, one of the things that they afford you is a no negative equity guarantee. And again, this is super important. If anyone's worried about this, or if I get equity release, I lose my home. Well, no, not necessarily. We've talked about that already. And I'm going to pass a load of debt on to my kids. No, it doesn't have to work like that either. Obviously, the loan does need to be repaid, plus obviously any of the interest that's accrued on it as well. But you have got protections. So the lender can never ask your estate. So when you pass away, they can never ask for any more than your property is sold for, less any of the sort of the costs that you've incurred in selling it. They can't ask for any more than that value back. There are actually, even if you want to make sure there's money left over, there are plans where you can protect equity as well. Maybe you say, I want to make sure that at least 5% of my property value is left at the end. Then we can do that for you with some of the plans that are available. Now, we've discussed how it is due back. The natural term end is when you pass away or move into long-term care, and then at that point the lender would be expected to be repaid. Now, the lenders don't want to be involved with selling the property. It's a really important thing. It is your estate that will be responsible for repaying it. So the executors of your will, the executors of your estate, will need to arrange for the money to be repaid. Obviously, most commonly it is from the sale proceeds of the property. You put the property on the market, it sells, yours and you repay the loan, and then any money that's left over goes into your estate. But if they want to keep it, they can do. If you've got other assets that in your estate they can release value on, sell, or investments and things, that could repay the lender. That's absolutely fine. Similarly, if they want to keep it, they can either buy it themselves or they can repay it from their own financial means. They could put a mortgage on it themselves. Maybe they're even old enough to get equity release on it themselves. So those are the sorts of things that can be available for the future. So don't think of equity release as, I get it, I lose my home, my kids don't make any benefit from it. It's just simply not true. That is, unless you have a home reversion plan. Home reversion plans do potentially give you access to more money, but they're not really relevant anymore, generally. Basically because they don't give you those extra features. You are, with a home reversion plan, you're actually selling part or all of your home to get the cash. So the lender, the home reversion provider, is actually taking a percentage of your home. And it's not like, you sell all of your home and they give you 100% of the property value. It's more likely going to be, you sell all of your home and they give you a third of it. And they say, well, that's because we're letting you live in it for the rest of your life rent-free, and we actually aren't going to be benefiting from that until we can sell it once the plan's ended. So as I say, it really, because of those lack of protections, it generally isn't something that we'd recommend. The real times it does come in is if someone's like, I've got no beneficiaries, my money's going to go, like, I don't know, maybe to a charity or something, and as much as I'd love to leave them something, actually, like, my needs are a bit more important right now, and if you really are struggling for the cash, you really don't want to downsize, then potentially a home reversion plan could be suitable. But chances are, when we're talking about equity release, we are talking about lifetime mortgages. They are just far superior in basically every way. There is a third one which I will mention. It's not strictly equity release, but they're called retirement interest-only mortgages. You may have heard of RIOs for short. Now, RIOs, they have a place in the market. I'll be honest, they're not amazing. There are some circumstances where it is really good for people. They are basically an interest-only mortgage, but it just doesn't have a term on it. So normally with an interest-only mortgage, you take it over, say, 20 years, and then at the end of that 20 years, you'd have to pay the capital back. And lots of people self-certified in the past, oh yes, I've got these investments, or I'll just sell the property later on and repay it from the sale proceeds. And that was quite commonplace 10, 15, 20 years ago, but now it's not really. You can still get them, but it's mainly some sort of specialist building societies that do interest-only mortgages. And then we've got RIOs. So they're kind of like a halfway house, if you were, between mortgage and equity release, because, as I say, they do run for the rest of your life. They haven't got a set term, but the downside is you've got to prove affordability, and sometimes those affordability assessments can seem a bit harsh. Generally, again, a very over generalization, is that you're looking at about 4.5 times income. So they're not just looking at your income today if you're working still. They're thinking about like what happens when you retire. And if you're like relying on state pension only, they're basically going to say, well, that's the minimum that you need to live. So that's not going to be able to be something that we can take into consideration for affordability assessments. So yeah, they're really looking at someone that is they've got investments. Maybe they're a company director or something. They've got dividends they can draw on. Maybe landlords or something where they've got that income that can still keep coming through into retirement even when they stop working. Even people that have got final salary pensions. I appreciate that's a bit of a dying breed, but if you do have something where you have that income guaranteed in retirement, it's something that could be a cheaper way for you to raise the cash. Again, when we're talking about interest rates, they're not fixed for life. It's much more like a residential mortgage where you'll be looking at like a 2 or 3 or 5, maybe a 10-year fixed term, and then after that it will go on to the prevailing rate. So it's great now, interest rates are low, you can get something sub 2%, which a lifetime mortgage just isn't going to be able to compete with. But the more that it goes on, potentially if we do see interest rates go back up, and I know when I speak to clients, they go, I remember when interest rates were in the teens, maybe even in the 20s, back in the 80s and the 90s and things. And if that were the case, you would need to keep up those payments. If you don't, you're going to be, you know, potentially evicted from your home. And that's the last thing that I want for anyone, which is why, again, just because of safeguards and things, most often it's a lifetime mortgage that on the rounded view, someone would go, yeah, you know what, that's probably the right thing for me. Okay, so we've talked about the fact that you don't need to repay it until you pass away or move into a care home, but I keep forgetting to mention that you can make voluntary payments if you wish. Now, generally, the lifetime mortgages, you'll find that they either come in a roll-up version, whereby the lender's expecting that you're not making repayments. And you can, but they might charge you a penalty for doing so. Then a vast majority of them have got features where you have a voluntary amount a year that you can contribute, and it's normally 10%. So if you borrow 100 grand, you know, 10 grand a year, which is a lot of money, you can pay back without any additional charges. But there are some plans that would do, you know, more. It goes up to sort of 40%. If you're really thinking, maybe I want to make lots of payments against it, maybe I actually don't want to have the mortgage going on for life. Maybe I want to pay the maximum that I can down outside of the any payment charge window, then it could be something that's really good for you. Almost like a short-term lending, maybe even consider it like a loan. Like, you know, you could take the money now, maybe that you have the 40% allowance and that you make those maximum payments. Think about it, you're going to pay it back in 3 years. So, you know, it's not something that necessarily needs to run for life. When I'm having a conversation with clients at meetings and I'm trying to uncover sort of their plans, you know, lots of people do say, well, having the option to make payments could be really helpful, especially considering that if you don't make those payments, you know, you do have interest accruing on interest. That's one of the big things that people don't like. They say, oh, I don't like equity release because of the compound interest. And I go, yep, you're absolutely right. You have compound interest if you don't make payments. But it's only at the end that your estate has to make that payment anyway. So it's not like it's a massive concern for you today. However, if you want to keep that down, you want to make sure there's more money left for your beneficiaries at the end, you want to be, you have the financial means to do it, then making payments towards it can be a great way to reduce the interest roll up on it. Because if you think, you know, when I'm looking at equity release plans, I'm thinking, how long does it take for the loan amount to double? That's kind of like a common way that I think about it. So, you know, say if you borrow 50 grand, I'm looking at how long does it take until you owe 100 grand? You know, the 50 grand that you've already borrowed, plus 50 grand's worth of interest. And if we go back, you know, 5 years, we were looking at interest doubling every 8 years, 10 years. And now, you know, when those rates are much lower, it's potentially 15, maybe even knocking on 20 years. So it's something that isn't necessarily a massive issue, especially when you look at property prices. And, you know, whilst from my perspective, I can't guarantee any future property growth. To be honest, if I could, I probably wouldn't be doing this right now. I'd be, you know, investing in it and putting all my eggs in one basket. But anyway, as an aside, if you were to take equity release and you have got that compound interest, it's actually only going to be on the money that you borrow. If you took 20% of the equity out of your property, you had a 5% interest rate, the interest is only going to be charged on that 20%. It's not on the whole property value. When you think about any property price growth that you may have, that's going to be on the whole property value, not just the loan amount. So maybe some of those numbers that look really scary at the bottom of the page when you think, oh, in 20 years' time I'll owe how much? That's as much as my property value. Yeah, but what was your property worth 20 years ago? And actually, you get the cash now. You can use it as you wish, quite often for things that you need, not just want. And then at the end, you know, your estate's responsible for paying it, but we've got the cap in there anyway. They're only going to owe as much as the property's worth as a maximum. So if house prices crash, you benefit, your estate benefits, you've made use of the funds now. So it's a bit of a weird one, and I know it's something you really have to get your head around to get comfortable with. That's one of the things that I really like to sit down and talk about, because it's not just a case of, oh, it's fine, you know, don't worry about it. It's really important to understand exactly how it works, because it's a case of balancing everything up. What's more important? Is it the money? Is the money the most important thing? Is the things that you want the money for more important? Maybe they're not. Maybe actually leaving the inheritance there is more important. Maybe having the security of having extra money available in your property is more of an important thing for you. So all those alternatives are the sorts of things that we cover off at a meeting, including things like downsizing. I know that's one of the big things that people talk about is, well, the way that I'll release equity is I'll downsize. And you can absolutely do that, and I'm a real advocate of people doing that. It's just that piece of going, well, it's not really comparing apples with apples, because you downsize, you've got to move, which for a lot of people, they've been in the properties for a long period of time. There's lots of memories and things. Maybe they even want to pass it down to the children. You move, you can't pass that family home down. Then there's costs associated to it. It's not just a case of I will move. Maybe there's moving fees, estate agency fees, maybe even stamp duty fees. So those sorts of things that also need to be considered in there as well. And then if somebody does say to me, well, I think that house prices are going to continue to grow in the long term. Well, if you've moved to something that's worth half as much, the growth that you're going to get as a pound amount is only going to be half of what it would have been if you stayed in your original property. So, if you can get a low enough interest rate, it may still be something that you might want to consider sort of versus downsizing. But all of those alternatives, massively important for me as well for you, to make sure that I'm recommending something that is in your best interest. I want to sleep at night. I don't want any knocks on my door. I always say, I'm not going to ask you to do anything that I wouldn't ask my parents to do. And I think that's really, really important. The final thing that I'll mention on making payments is that most of them where you make the voluntary payments, it's sort of payment types. You can make payments over the phone them up, make card payments. A lot of them now take bank transfers. So you can set up a standing order from your bank if you want the money to be going over to them on a set regular basis. Or you can make check payments and those sort of things. But some plans do allow you to make payment by direct debit. And actually, one of the lenders gives you a reduction whilst you're making payments by direct debit. So if you are planning to make those regular payments for some period of time, then that can be a good way of doing so, because it can actually help you obtain a better interest rate. The great thing as well is, even if it is set up by direct debit, you're not bound to making the payments. If you stop, it's fine. You're safe. Your house isn't at risk. All that will happen is that it will revert to the roll-up, and the interest will just accrue in the background. Generally, it's a case of if you miss 3 payments, then it reverts. So either because you didn't have the funds in your account, or maybe you just went, I don't want to do this anymore. You don't need to phone the lender. You don't need to tell them. Just cancel the direct debit, and the rest will happen. The next thing that we're going to talk about is qualifying for equity release. It's something that comes up quite often. People contact us and say, do I qualify for equity release? Does my property qualify for equity release? In terms of qualifying for equity release, the biggest thing is your property. It's the lender security. They aren't expecting you to make any payments during the term. So in terms of that, there's no affordability assessments to go through. If you've got bad credit, it's not a problem. They're just looking at the property itself. They want to make sure that, in 20, 30 years time, whenever it is that the plan might end, that it's going to be something that can be resold at a decent market value, and that will be enough to repay the equity release balance. So as part of any process, they will need to do a valuation on the property. That would be by an independent surveyor. There's a few different firms they use. Countrywide is one of the ones that's commonly used, but it will generally be a national firm. Most of the valuations are actually free. Or free being included in the price of the equity release. And that could be a really important thing, because most people that I speak with that want the equity release is because they are, the typical asset rich, cash poor. They haven't got 500 quid to pay out of their pocket now. So the idea of having that risk associated with an equity release plan is generally one that I don't like. You can potentially have a plan with a valuation fee payable up front. You might even find you get a lower interest rate, but you have to sort of balance that up with, well, what happens if my property doesn't value up where I wanted it to, or potentially the lender comes back and says, actually, no, we're not happy to lend on it because of X, Y, and Z. I just like to de-risk you, really. Get the free valuation if you can, make the most of it, and try to put yourself in a situation where you've paid nothing up front, you've only got the fees to pay, if you get your equity release funds. Okay, so qualifying for it, we've said that it's mainly on the property. There's no sort of financial constraints from your side. Obviously, they will still do basic credit checks, that you're not bankrupt, make sure you own the home. As I say, if there's any mortgages that are outstanding on the property, they do need to be repaid, but you can use the equity release proceeds to do so. Then it's just going to be the sort of actual mechanics of the property, like what's it constructed of? Is it standard? Is it bricks, mortar, stone, cavity walls, those sorts of things? Or is it maybe something wacky like a barn conversion, or completely made out of wood, or thatched roofs and things? And it's not to say that if they are those sorts of things that you can't do it, it's just that it might restrict you on a certain lender or product that that's available. So one of the things that I normally like to do is to come out and look at your property. Unfortunately, because of COVID, that's quite difficult at the moment. So most of the time I'm doing things over the phone or by Zoom. And you can show me things you want. If there's something that you're worried about, I say take pictures. I can also use things like Google Street Maps and Google Aerial Views as well to look at it. If the property's been on the market in the past, you can even find some of those old pictures and things that are archived on Zoopla and things. So I quite often look at those sorts of things to help me understand your property. But really it comes back down to the surveyor on the day. They need to be comfortable that it's something that is structurally sound, that it's not going to pose a big problem for the lender in the future, or even you, to be honest. They don't want you to be in a situation where 10 years down the line suddenly the property needs 100 grand spent on it and that you just can't afford to do it, the lender can't afford to do it, and the property just falls into disrepair. That's like the last thing that they want. So if you're worried about your construction type, anything quirky, let me know, and we can work through that and to find a lender that's probably best suited for that. But really it's going to come down to the surveyor on the day. So I will just mention now, actually, when you do have a survey, don't lie to the surveyor, don't hide anything. If they ask you a question, be honest. But if there are things that maybe you think might be an issue, just flag it with me, because I can help you out with it before it gets to evaluation. I'm not talking about anything drastic, but like if I've had someone say to me, oh yeah, well I did have that radiator leak upstairs 20 years ago and there's that stain on the ceiling, I just never got round to painting it. Maybe they're the sort of things that a quick 2-minute spray can or a quick roller job might actually really help with, because it just means that the surveyor doesn't need to ask the questions because it's not a problem. But if the surveyor goes round and like there's a hole in the ceiling or something, then they're going to be going, what happened here? And that's where further investigative works are going to be needed, and that's the sort of stuff that can cost you money. So let me know up front. I'll try my best to help you. Don't be afraid to tell me something. I'm working for you. Yes, you're having to represent the lenders, but I am working for you. So if you're worried, shout. Okay, so we've talked a little bit about the valuations. It's kind of actually a bit of a bridge into the general process, actually. So, and when I say process, I mean how do you get your funds? So the first thing that you need to do is get advice from a qualified financial advisor like me, somebody who has not just their mortgage advice qualifications, but also their equity release advice qualifications. They will go through and make an advised sale to you. I should probably say recommendation, that's a much nicer way of putting it. But essentially the FCA, the governing body that looks after all financial advice in the UK, say that equity release needs to be sold on an advised sale basis. What that means is you can't just choose the product. If you go, I want this credit card, I want this loan, I even potentially want this mortgage, you can just go to your bank and say, I'll have that one please, and they can do that for you without asking too many questions. Yes, you've got to go through the application process, but it's not like they're saying to you, I need to tell you if that's right for you or not. Whereas equity release is different. And it is an extra safeguard, and it's brilliant that it's in there. And it's really important that I work with you and you see that I'm working with you, listening to you, understanding your needs. But it is for me to recommend something to you as the best option. Sometimes it might be, actually, I don't recommend you do equity release because you've got 200 grand in the bank, you don't need the funds, come back to me when you do. There's lots of sorts of things like that. So it's a sold and advised sale process. So you need to have an initial meeting with an advisor. They will get to know you, and they'll talk about the sort of things that you're trying to achieve, and then also trying to give you a bit more of a rundown of what equity release is, what the different types of products are, the different types of features. Get information from you as to sort of things that are important to you. Consider those alternatives, and also really importantly, not just think about today, think about in the future. What happens when things change? What happens if you have like a shift in your income or something? Maybe if you are a joint borrower, what happens if one of you passes away or moves into a care home? Do you want to stay in the property? Can you? Do you have the financial means to stay in the property? They're the sorts of things we need to consider, because there's some great features out there. Things like significant life event exemptions. Some plans allow you to repay within 3 years of the first death or the first person moving into a care home. And I think for any joint borrower, these are things that are just essential, with plans. You don't know what it's going to be like when you get there. I've got family members that, when when loved ones pass away, they might just not want to go back to the property at all. Not just a case of not live there, just not want to go there. And that, those sorts of things can be really difficult and really difficult to sort of plan for as well. So I think that any plan that gives you more flexibility, the better it is. Significant life event exemption is a great feature for joint borrowers. It allows you to repay within 3 years of the death of the first borrower or when the first borrower moves into long-term care. The way that it was explained to me by a lender is we give you a year to grieve, we give you a year to plan, we give you a year to action. And I think that's a really fair way of looking at it, because reality is, even if you think you know what's going to happen, when you get there, it might be completely on its head. And to be honest, you don't want to be stressing that you definitely need to sell the property. You don't want to be stressing that you definitely can't sell the property. Having a year to sort of grieve and then deal with the planning of it is the best thing for you. We offer free initial consultations, so if you do want to explore your equity release options in more detail, do get in touch with us. It's something that we do with you, as I say, free of charge. We can do it over the phone, we can do it over Zoom, video call, however best works for you. And that gives you really an opportunity to fully explore equity release tailored to you. Right, so after your equity release initial consultation, they take about an hour, 2 hours, basically depending on how much information in detail that we need to go into. We will go away, we'll go and do our research into products that are available, and then come back to you with a recommendation. We'll give you a key facts illustration document, which will is about a 10-page document, and all the lenders have to produce them in the same way. So once you know one, you kind of know them all. Yes, the colours might be different logos on there, and there will be some different terms in there, but the actual structure that they go through will be identical. So it's really good for us because it means that we can compare them nice and easily for you. And in there, we'll go through basically like the benefits of the plan, and we'll go through the risks associated with the plan as well, because let's face it, any financial arrangement that you have in place has risks associated. It's important to cover those, probably even more so than the benefits. So we'll go through that with you. We'll look at how like the interest accrues on a loan. We'll look at the mortgage balance, what it would be at different points, and then we'll look at those sort of exemptions and things as well. Recover off obviously all the questions that you might have had while sleeping on it in the meantime. Talk to you about the reasons why we're recommending that as well. Then from there, you can decide what you want to do. There's no pressure. If if after that, basically, you decide you don't want to do it, or I decide the best thing for you is not to do it, then I'll tell you that, and we'll and I'll be very thankful that you've explored it, and hopefully you can tell your friends about it as well, because hopefully we've done a good job for you. But if you do want to go ahead, it's generally quite an easy process. Some lenders have paper applications, some others have online portals where I can submit it saying that I've given you the advice. But I will need from you some sort of proof of ID, proof of address, some basic information like that. And then that allows me to submit an application to the lender. Most of them, as I say, have got no upfront fees. Really the only upfront fee that you're ever going to really have is a valuation fee, or some advisors charge an upfront fee. We don't, we never have. And I think that's one of our big USPs. So it's completely no risk to you by submitting an application. You then get the evaluation instructed on the property. That's usually within a week of the application going in. Once the surveyor's been out, he probably wants 2 days to make the report, and then the lender, once they've received the report, probably want another 2 days as well. And at that point, they'll go through all the property underwriting, look at all the details from it, and that's where they make the formal mortgage offer. So the formal mortgage offer comes out to you as a hard copy. We generally get a soft copy as well, and a copy will also go to your solicitors, who also need to be involved in the process. And the mortgage offer will go look very similar to a key facts illustration, but what you'll see in a key facts illustration is it will say things like, you told me that you think your home is worth 300,000. And then when the mortgage offer comes through, it says, we know that your property is 300,000. So they're very easy to follow on because they contain lots of the same information. Some mortgage offers have got special conditions attached to them at the end. So, if there are maybe essential works that need to be carried out, or if it's a mortgage that needs paying off, you might see some sort of special conditions written into the mortgage offer. And then once that mortgage offer has been made, that's when the solicitors get involved. And with equity release, you don't just need our advice from a financial perspective, but you also need solicitors involved from the legal perspective as well. Again, this is another great safeguard. Don't see it as a downside. I know, going back many years, but actually advisors could do both essentially. And there are some horror stories, associated with some rogue advisors that were doing the wrong thing for clients. So, it's a great safeguard. You don't just get the financial advice, you get the legal advice as well, so you know exactly what happens with the plan and what that could mean for you in the future. So the mortgage offer goes to you, as I say, it goes to the solicitor. At that point, the solicitor will start the conveyancing process from their side. They will get in touch with you to arrange a legal advice meeting. They do need to witness you signing the mortgage deed. That's one of the things that will be required. Most of the times, again, solicitors want to see you face to face. I know because of COVID that some of them are doing it remotely, maybe over video call or something. And I'm really happy to recommend to you Ashfords. Ashfords are a national firm of solicitors, and they've got offices throughout the southwest and south of the country. They've got an office in London. They've got office in Bristol, Tiverton. They've got Taunton, and they've got the main processing of the equity release out Exeter. But they've also got a national network of solicitors that can come out to your property and see you. So it's one of the things where quite often clients will go, okay, come to me, give me the advice in my home, I'll sign the paperwork, and then we can go from there. Ashfords are a great firm that we've worked with them for 5 years, and they've done a great job for us every step of the way. So we're really happy to recommend them. They do about 800 cases a month. I wish we were doing that ourselves. We were doing a very small amount compared to that, but they have a big team of people that are specialists in equity release, and they can do a great job for you in giving you the equity release advice and getting it over the line. Really importantly, they are your solicitors, so you can use whoever you want. The lender can't tell you who to use. I can't tell you who to use. But if you don't have anyone that is qualified to give the equity release legal advice that you want to use, then I'm really happy to recommend Ashfords to you. Great. So once you've had your solicitor's appointment, then you've got the paperwork signed, that goes back to the lender solicitor. So not only do you need a solicitor, the lender also needs a solicitor as well, and they sort of go through the legal side of things together. Once the paperwork's been gone through and all the I's have been dotted and T's have been crossed, then that's when the money is transferred by the lender to their solicitor, and then their solicitor to your solicitor, and in sort of that process, any mortgages that are on the property need to be repaid. So the solicitors do all that for you. There's nothing for you to worry about there, and then any money that's left over gets paid into your account. Then you can spend the money however you want. In terms of the process, I generally advise people it takes about 8 to 12 weeks. I have seen it done quicker. The quickest I've seen is 3 weeks. I'll be honest, that was before COVID. COVID has made it a bit more difficult, not just from the equity release perspective, just in general, I think we can all appreciate that. Post takes longer, where you've got people working from home and things, it can make it a bit slower. Because they need original copies of things that might be sent to head office, but then they need to get a scanned copy of it out to people at home as well. So generally I would allow a little bit more at the moment. 8 to 12 weeks is completely reasonable. If you're buying a home, you're in a chain or anything like that, a lot of those things will be outside of control. And if you're not, then again, we'll try and do everything we can do up front to make sure that the process is as quick as possible. One of the things that we do is pull a copy of your title deeds from Land Registry, and we look to see if there's any charges or anything on the property so that we can discuss those at the equity release meeting. So it's not suddenly a case of like the solicitors get hold of the application and go, oh, I didn't know about this mortgage, or oh, I didn't know about this other charge, or oh, I didn't realise that there was someone else on the title deeds that isn't party to the application. Those are the sorts of things that we try really hard to uncover up front to make the process as quick as possible. Okay, I'm just going to go through drawdown equity release plans now. These are kind of like a subset of lifetime mortgages. So within lifetime mortgages, you can either have lump sum products, which, as the name suggests, give you all the money in one go, or you can have drawdown products. And with drawdown products, you get an initial amount of money up front, and then you have a pre-agreed reserve facility that you can access as and when you need it. So what I generally say to people is, if you need money, immediately, like in the next year or two, and you're planning to spend it, take it now because you fix the interest rate from the start and you're going to be spending it quite quickly. But if there's any more money that you might need, say in 2 to 10 years, put it in a reserve facility because you're not paying any interest on it. The money in reserve doesn't attract interest until you start drawing upon it. And even then, you only pay interest on the money that you've drawn upon. So, if you were to think about it as, you borrow 100 grand, make the maths nice and easy. If you were going to spend, say, 20 grand initially and put 80 grand in the bank, well, at the moment, you're not going to earn very much money on the 80 grand in the bank, and you're going to be paying considerably more than that in the interest charges that are accruing on the lifetime mortgage. Whereas if you get a reserve facility, you can get that 20 grand up front and you can have the interest that's accruing on that. And then you can have that 80 grand left over with the lender, pre-agreed, that you can access when you need it. You don't need to go through the whole process again. You don't need to have another valuation, more solicitors involved. You don't even need another financial advice meeting. I'd still recommend that you do it. But there's nothing stopping you from contacting the lender directly. They would typically, you request a certain amount of money. They would send you a new sub-mortgage offer document for that new loan amount. The old one will continue on the same terms, and then that new amount of money that you would be requested, you'd have to sign to say that you accept it. You send that new document back to the lender, and then they transfer the money to you in about 14 days. Okay, so that basically wraps up everything that I wanted to go through today. I hope that you found this content helpful. I know it's been a long one to go through, and there's been a lot of information to unpack in here, but it's not just useful for you, it's going to be really useful for if you've got like family, friends, anyone that you might want to involve in the equity release process. Please share it with them. It might sort of help them understand how the process works, and make you hopefully feel safer and more secure in the process as well. If you have found it helpful, please hit the like button. You can subscribe to our channel for more content like this. And if you want to get in touch for an advice meeting, as I say, free initial consultations, www.moneyrelease.co.uk, and you can reach us on 0207 158 0881. Hope you're all good. Hope you found it useful. See you soon.